Okay, let's talk about Hertz Global Holdings, HTZ. Because honestly, the signals coming from this stock are probably the most mixed, maybe even confusing we've seen all quarter. Is it a turnaround in the making? Or is the company just fundamentally, stuck? We need to figure out what's really going on here. Welcome to De-Risk, a podcast where we provide a no-nonsense analysis of stocks.
And that's exactly what we're aiming for in this deep dive. We've pulled together our research, and this data is current as of September 30, 2025, to really unpack why there's so much conflict surrounding Hertz right now. We want to isolate what actually matters for you.
Right. So let's set the scene first. The broader market context, it feels cautious, doesn't it? S&P, NASDAQ, Q futures, we're looking a bit softer.
Yeah, definitely cautious. And we're in this strange spot. U.S. GDP looks pretty solid on the surface, but you still hear these whispers about a recession.
It is weird.
And you see real signs like the slowdown in heavy truck sales. That's often a canary in the coal mine for industrial activity. And that kind of thing makes markets nervous about riskier assets, like Hertz.
Okay, but despite that backdrop, Hertz itself made a pretty big move recently. They closed that $425 million financing deal.
They did.
And, the fact that a big player like Pershing Square backed that, well, that feels like a pretty strong vote of confidence. Gives them breathing room, flexibility.
It absolutely does provide liquidity.
Yeah.
But here's where the fundamental conflict really bites. If you try to value Hertz using, say, a discounted cash flow model, a DCF.
Looking forward.
Exactly. Looking forward, projecting future cash flows.
Mm-hmm.
That model can spit out a, frankly, astronomical fair value. We saw one suggesting $91.79 a share.
Wow. Okay, $90. That implies huge optimism about their future, right? What kind of turnaround are they baking in there?
They're betting big on future profits. Strong cash flow, maybe a high exit multiple down the line.
Yeah.
But, and this is the kicker, you look at the company's net profit margin, it's deep in the red.
Right. Not profitable currently.
Not at all. So if you use a different model, one based on current earnings, well, it gives you a negative value. That massive gap between potential future and current reality, that's the core problem here.
And Wall Street analysts seem stuck in the middle too.
Completely stuck. Not one single buy rating out there. It's basically split. 60% are saying hold, just wait and see. The other 40%. They're outright sell, or even strong sell.
So that uncertainty, that division, it must be showing up in how people are trading the stock, the sentiment.
Oh, absolutely. It's like a civil war in sentiment. On the one side, you have the bears, and they are not messing around.
How bearish are we talking?
We're talking enormous. The short interest is, get this, 43.55% of the available stock float.
43%. That is massive. That's a huge weight pressing down on the price. A big bet it's going lower.
A colossal bet.
Yeah.
But then, and this is wild, you look at the options market, totally different story.
Okay. What are the options traders doing?
The put-to-call ratio is incredibly low, just 0.25.
0.25. So break that down.
It means for every one person buying a bearish put option, there are 4 people buying bullish call options. The actual money flowing in the options market right now, overwhelmingly bullish.
Huh. So the shorts are piling in, but the options players are betting on a rise. Where are the sort of battle lines drawn on the price chart?
You can see it pretty clearly. The bulls, the call buyers, they seem to be trying to defend that $7 strike price. That's their line in the sand.
$7.
Meanwhile, the bears, the put buyers, they're stacking their bets just below that, heavily concentrated around the $6 level. That's the next critical zone downwards.
Okay, so fundamentals are conflicted, sentiment is polarized.
Right.
What about the technicals? Is the chart giving us any clearer direction, the momentum?
Well, the longer-term technical trend is still positive, which you can't ignore. It suggests the bigger picture might still be intact. However, the short-term momentum, that's clearly fading.
Losing steam.
Definitely losing steam. Our indicators show the recent upward push is tired. The rally looks exhausted right now.
Okay, bringing it all together then. Conflicting fundamentals, polarized sentiment, fading short-term momentum. What's the final call, the strategic verdict here?
After weighing everything, our verdict is neutral, but with a distinct bearish bias.
Neutral, leaning bearish. Why the lean towards the bears?
It really comes down to that combination. The nervous wider market, Hertz's own profitability struggles right now, that fading short-term momentum we just mentioned, and critically, you just can't ignore that massive 43.55% short interest. It's just too big.
But you have to remember, that huge short position, it cuts both ways, right? That's also the biggest upside risk here.
Exactly. It's a potential rocket fuel for a short squeeze, especially if you combine it with all that bullish options activity we saw. A little bit of good news could trigger a big move up.
So for you, listening right now, what are the absolute key levels to watch?
The lines are pretty clear. For the bulls to regain control, they really need to push back above $7 and hold it. That would show renewed confidence.
And the downside, the point where the bearish view really takes over.
That's the $6 level we mentioned earlier. If the price breaks below $6 and stays there, that's a major warning sign. It would really confirm the bearish thesis for us.
All right. So here's a final thought to leave you with. This whole Hertz situation, it's almost like a test of market physics, isn't it?
Yeah.
Is that giant 43% short interest going to act like a lead weight, inevitably pulling the stock down? Or is it actually highly explosive fuel just sitting there waiting for one tiny spark to ignite a massive short squeeze? That's the real drama here.
That's all for this deep dive. As always, this analysis is designed to inform you, but remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.